think you really need to take the market more holistically. Look at supply levels. The listing numbers remaining extremely low are a pretty good hint that there's going to be this mismatch between supply and demand for some time yet, although I think it will gradually start to normalise. Some of the really timely indicators like auction clearance rates are still very useful for Sydney, Melbourne and Canberra. The correlation between clearance rates and pace of capital growth is nearly perfect. It's like a 95% correlation. So despite some of the noise that's come into the auction readings, so that's another really good one. And the housing finance data, typically credit is well and truly interweaved in housing market activity. So watching the credit trends is also really important. We've already seen this changing of the guard where first home buyer credit growth or new credit growth has slipped into negatives. Non-first home buyer owner occupier credit growth is slowing a little bit, but investors holding up at around 10% month on month. Still very strong credit growth, but it's starting to change across the different sectors. Some of those regional markets I mentioned where the growth rates were quite spectacular, Byron is probably the best example where housing values are up in Byron like 30% in a year. Those markets are becoming really unaffordable. So I think you'd have to expect there's going to be a bit of a ripple of demand towards some of the more affordable coastal lifestyle markets. Gympie was probably one of the better examples there, just north of Noosa, where we're starting to see very strong growth conditions coming into Wide Bay, which is Harvey Bay, up in Queensland as well, Victoria, around the Gippsland region. But I think once we get COVID under control, this is where that trend becomes a lot less certain. And even coming into early this year, there seemed to be a lot more pressure from governments and from employers to start to get staff more regularly back into the office. And I think that'll probably be a trend that persists. I have no doubt that flexible working arrangements will be a legacy of COVID, but probably not to the same extent that a lot of us have enjoyed through, say, the second half of last year and earlier this year. So with that in mind, you'd have to expect that there probably will be somewhat of a resurgence back into capital city markets, particularly those inner city precincts where the affordability of housing has relatively become a little bit better, considering a lot of those outer fringe markets have outperformed the inner city precincts and the inner city markets. Gradually, absolutely, we will see more supply coming into the marketplace. We'll also see a lot of upwards pressure on construction costs due to the fact that, go to Bunnings and try to find a piece of wood. It's pretty hard at the moment, so let alone for a builder. So you've got this situation where you'd have to expect that demand side is going to start to gradually ease. The supply side will probably gradually increase as well. And that's where we'll start to see a rebalancing between buyers and sellers. So don't expect it to happen really quickly. I think this is going to be a very gradual thing, but through the second half of this year, I think we should expect that listing numbers will gradually start to get a bit more back to normal levels due to that slowing in buyer demand and gradual increase in overall stock levels. The main one that stands out to me, of course, is COVID. The spot lockdowns and the outbreaks of Delta have been very disruptive. Through lockdowns, housing markets tend to go on pause. You see much less transactional activity, both from a buying and a selling perspective. You see that volatility in clearance rates that I pointed out a bit earlier on. And then once the lockdowns are lifted and restrictions become a little bit more looser, you see things bounce back quite quickly. In fact, I wouldn't be surprised if we come into spring, there is a lot of pent-up demand that's being unleashed into the marketplace.